You're being told the crypto market is volatile and uncertain, that it's just for speculators. But what if that's the story they want you to believe? While most people have been glued to the short term price swings, some of the wealthiest people and largest institutions in the world have been quietly and systematically buying up Bitcoin. This isn't about making a quick buck. This is about a fundamental shift in the global economy. And in this video, I'm going to show you the secret economic indicators that are forcing their hand and what it means for the future of your money. Let's be real, for the last few years, the mainstream story around Bitcoin has been a mess. One day, it's the future of finance. The next, it's a failed experiment. You've been hit with headlines about price crashes, celebrity endorsements gone wrong, and complicated scams that make you want to just ignore it all. This noise, this chaos is a distraction. It's designed to keep the average person on the sidelines feeling like the opportunity is either too risky or has already passed. But behind the curtain, the real story has been unfolding. A quiet, calculated movement of serious capital. We're talking about the smart money, the money that doesn't gamble but makes strategic long-term moves. Hedge funds, asset managers, corporations, and the billionaires who run them have stopped asking if they should own Bitcoin and started asking how much they can buy without sending the market into a frenzy. What do they know that you don't? They don't have a crystal ball. They're just paying attention to a different set of signals. They aren't staring at the daily price chart. They're looking at global debt clocks, central bank balance sheets, and the changing rule books of finance. They see a system under massive pressure, and they are getting ready for what comes next. In 2025, this quiet buying has become a tidal wave, all thanks to a few key developments that finally opened the door for big money to flood into digital assets. We're going to break down what's happening, the regulated gateway that opened the floodgates, the hidden economic pressures forcing their hand, and what this all means for you. The single biggest event that kicked off this billionaire buying spree wasn't a new technology, it was a piece of paper, a regulatory filing, specifically the US Securities and Exchange Commission's approval of spot Bitcoin ETFs in January 2024. For years, this was the holy grail for big investors. It was the missing piece that kept trillions of dollars out of Bitcoin. Before the ETFs, if a major hedge fund wanted to buy Bitcoin, it was a nightmare. They had to deal with a confusing web of crypto exchanges, figure out how to securely store it without getting hacked, and navigate a mountain of compliance headaches. It was complicated, risky, and for anyone managing other people's money, it was basically a non starter. Time and time again, they cited regulatory uncertainty as the main reason they stayed away. The spot Bitcoin ETF changed everything overnight. It created a vehicle that was instantly familiar, regulated, and dead simple for any major financial player. For a hedge fund manager, buying shares in a Bitcoin ETF like BlackRock's iShares Bitcoin Trust, IBIT, is as easy as buying a share of Apple or Microsoft. They do it through their normal brokerage accounts, and titans of finance like BlackRock and Fidelity handle all the tough stuff like custody and security. It completely removed the operational headaches and the career risk of touching a fringe asset. The result? A wave of capital. The launch of these ETFs was one of the most successful in history. BlackRock's IBIT alone pulled in tens of billions in assets in a remarkably short period, proving just how much pent-up demand there was. This wasn't just retail FOMO. This was the sound of institutional floodgates creaking open. But that initial surge was just the beginning. Throughout 2024 and into 2025, the flow of money has been a two-way street, with periods of major inflows and significant outflows. This shows the market is maturing, with institutional capital now providing constant buying and selling pressure. The ETF approval was more than just a product launch. It was a signal. It was the ultimate stamp of legitimacy from the world's most powerful financial regulator. It told every boardroom and investment committee that Bitcoin was no longer some fringe asset. It had been officially welcomed into the financial system. This green light gave institutions the cover they needed to justify allocations to their boards and clients. Without the ETF, the billionaire buying we're seeing in 2025 would be impossible. It created a safe, regulated, and simple bridge from old finance to new digital money, and a river of gold started flowing across it. With the gateway now open, the question is, why are they so eager to rush through it? It's not just because they can, it's because a perfect storm of economic forces is pushing them to. These are the things that don't make front page news, but are on the agenda in every high-level financial strategy meeting. Indicator number one, the silent thief, a hedge against currency devaluation. The first and most important driver is the health of our global monetary system. Billionaires and institutions manage huge amounts of wealth, and their number one goal isn't to get rich, but to stay rich. Their biggest enemy is the silent erosion of their buying power, better known as inflation and currency debasement. And right now, the alarm bells are screaming. Around the world, central banks have printed staggering amounts of money to keep economies afloat. While that might fix short term problems, it has a long term cost. The value of currencies like the US dollar is being diluted. Every new dollar printed makes the ones in your bank account worth a little less. For an individual, that's concerning. For an institution holding billions, it's a code red emergency. Historically, the go to asset for protection has been gold. But a new generation of fund managers sees a better alternative: Bitcoin. They call it digital gold, and for good reason. Bitcoin has many of the qualities that make gold a good store of value, but it has two properties that make it even better for our times. First, it is absolutely scarce. We know with mathematical certainty that there will only ever be 21 million Bitcoin. No central bank, government, or CEO can decide to create more. This programmed scarcity is a huge contrast to fiat currency, which can be printed endlessly. Second, it's decentralized. The network is run by thousands of computers worldwide and belongs to no one. This makes it extremely resistant to being seized, censored, or manipulated by any single entity. Billionaires aren't buying Bitcoin because they think it will replace the dollar tomorrow. They're buying it as an insurance policy. They see a global financial system that's looking increasingly shaky and are putting a small percentage of their wealth, usually 1% to 5%, into an asset that exists completely outside of that system. It's a hedge against continued high inflation and the ongoing devaluation of the world's major currencies. They look at the fixed supply of 21 million Bitcoin, compare it to the endlessly expanding balance sheets of central banks, and the choice becomes not just logical, but essential. Indicator number two: the death of the 60-40 portfolio, the hunt for new growth. For decades, the playbook for managing wealth was the 60-40 portfolio: 60% in stocks for growth, 40% in bonds for safety. The idea was that when stocks zigged, bonds zagged, smoothing out your returns. But in today's economy, that model is on life support. With interest rates manipulated by central banks and bond yields that can't even keep up with inflation, the safe part of the portfolio isn't doing its job anymore. This has sent big money investors on a desperate search for a new kind of asset, one that offers serious growth potential, but is also non correlated to the traditional markets. A non correlated asset is one that dances to its own beat, so its price doesn't just follow stocks and bonds. It adds real diversification, acting as a buffer when mainstream markets get chaotic. Enter Bitcoin. While it's not perfectly non correlated, Bitcoin has proven time and again that it follows its own cycles driven by adoption, technology, and halving events. Its performance often has little to do with the quarterly earnings reports or central bank meetings that move stocks. Studies have shown that adding even a small amount of Bitcoin to a traditional portfolio can dramatically boost its overall performance without adding much risk. For a modern portfolio manager, that's the holy grail. And the growth potential is just too big to ignore. We are still in the early days of Bitcoin's adoption. Even with its incredible price growth, its total market cap is just a fraction of assets like gold. Analysts at firms like Bitwise Asset Management have put out long-term price targets, with one projecting a potential path to $1.3 million per coin by 2035. For a hedge fund manager, this combination is electrifying. They see an asset that can both protect their portfolio during downturns and supercharge its returns during upturns. They're no longer asking, is it too risky to allocate to Bitcoin? They're now asking, is it too risky not to? Indicator number three: the green light of regulation making crypto safe. It might sound strange, but one of the biggest bullish signals for institutions is more regulation. For years, the Wild West nature of crypto was what kept them away. Big institutions need clear rules of the road. They need to know how assets are taxed, how they should be stored, and what their legal duties are. The confusion was a legal and compliance minefield. The period leading into 2025 has been all about governments, especially in the US, finally bringing some clarity. The approval of the spot ETFs was the first domino to fall, but it hasn't stopped there. Regulators are working on clarifying custody rules, creating tax frameworks, and setting up licensing for firms in the space. For the average person, talk of regulation can sound boring or even scary. For a billion-dollar institution, it's the most exciting news in the world. Every new rule and every clarified guideline de-risks the asset class. It removes uncertainty and replaces it with a predictable system. This process is systematically tearing down the walls that kept big money on the sidelines. Financial giants like Fidelity and BlackRock haven't just launched Bitcoin products. They've been actively working with regulators to help shape these new rules. They want to operate in a regulated market because it protects them and their clients, and it unlocks the ability to offer digital assets to a much wider audience, like pension funds and retirement accounts. So when billionaires see this regulatory momentum, they don't see a crackdown. They see a safe and sturdy market structure being built. They see the financial system being replumbed to include Bitcoin at its foundation. This regulatory clarity is the final piece of the puzzle, turning Bitcoin from a risky gamble into a legitimate investable asset in the eyes of the world's most conservative investors. If you're getting value from this look inside the institutional mindset and you want to stay ahead of the big money moves in crypto, do me a favor and hit that subscribe button and turn on notifications. The financial landscape is changing faster than ever, and my goal here is to give you the clarity you need to navigate it. Thanks for the support. Now, let's get back to it. The theory is one thing, but the proof is in the actions of those with the most to lose. The move into Bitcoin is no longer a fringe theory. It's being led by some of the most respected players in finance and tech. The prime example is Michael Saylor, the CEO of MicroStrategy. Years ago, he made a revolutionary decision. He realized the cash sitting on his company's balance sheet was losing value every single day to inflation, calling it a melting ice cube. His solution? Convert his company's treasury reserves from US dollars into Bitcoin. It was seen as a radical move, but it has since proven to be a masterstroke, preserving and massively growing his company's wealth. He wasn't speculating. He was choosing what he believed was a superior treasury reserve asset. The Saylor strategy has been copied by a growing list of companies. They're waking up to the fact that holding piles of depreciating cash is a losing game. While not everyone is going to the same extreme, the trend of allocating a slice of corporate treasuries to Bitcoin is picking up speed. Beyond the corporate world, the billionaire class is making its move. We're seeing figures who once dismissed Bitcoin now publicly changing their minds. They don't do this lightly, their reputations are on the line. When a hedge fund titan or a legendary investor starts buying Bitcoin, it's after months, if not years, of deep research by their smartest analysts. They've looked at every angle and concluded that owning Bitcoin is a smart financial decision. While giants like Fidelity and BlackRock are at the forefront of offering Bitcoin products to clients, it's crucial to note a distinction. They manage trillions, and their Bitcoin ETFs hold billions on behalf of their customers. However, there's no public evidence that they've allocated their own corporate treasuries to Bitcoin in the same way as MicroStrategy. Instead, their vote of confidence comes from building the entire infrastructure for other institutions to get involved. The launch of the ETFs has made this all much easier. A corporation or fund can now get Bitcoin exposure with a simple purchase of an ETF share, which is easy to account for and explain to shareholders. The pioneers have proven the model, and now the mainstream corporate and investment world is starting to follow. As huge as the Bitcoin story is, it's important to understand that this institutional wave isn't stopping there. The infrastructure and regulatory clarity built for Bitcoin are paving the way for a much bigger trend. What billionaires and forward-thinking institutions see is that Bitcoin is just the start. In 2025, we've already seen this ripple effect. Following the success of the Bitcoin ETFs, the SEC also approved spot ETFs for Ethereum, the second largest cryptocurrency. This is a huge deal. It signals that regulators are getting comfortable with digital assets as a whole. Now, the market is buzzing with anticipation for ETFs for other major cryptocurrencies, with filings already in for assets like Solana. This expansion is critical. It shows that institutional interest isn't just a one-trick pony. The technology behind these different assets offers unique features, from decentralized applications and faster payments to the tokenization of real-world assets like real estate and art. At the same time, technological upgrades like the maturation of the Bitcoin Lightning Network are tackling old criticisms about speed and transaction costs, making the network more usable for everyday payments. This growing ecosystem of utility adds another fundamental layer to the investment case. It's no longer just about a store of value. It's about being an early investor in a completely new financial and technological plumbing for the world. The billionaires buying today aren't just buying magic internet money, they're buying a stake in the base layer of a new digital economy. They saw the Bitcoin ETF approval not as the end game, but as the opening shot in the tokenization of everything. The same way the internet changed information, blockchain technology is set to change value. The institutional money pouring in now is the smart money getting in position for that much bigger, long-term shift. So, the game has changed. The world's biggest financial players are now in the market. What does this mean for you, the individual investor? First, the most immediate impact is on price. It's simple supply and demand. The supply of Bitcoin is fixed and predictable. Now, a huge new source of demand has been turned on. Institutional demand isn't fickle, it's large, sticky, and often not sensitive to daily price moves. Funds are buying to hit allocation targets, not to time the market. This creates powerful and steady buying pressure, acting as a strong demand floor for the price. It's a key reason we saw Bitcoin's price surge to new all time highs in 2025, briefly touching levels over $126,000. This new institutional presence has led some analysts to believe that the gut wrenching 80 to 90% bear market crashes of the past may be over, replaced by a more stable structural uptrend. While that is still a theory and corrections will absolutely still happen, the market dynamics have clearly changed. Second, this whole shift tackles the classic retail investor fear, FOMO, or the fear of missing out. But this time is different. This isn't about chasing a hot trend. It's about having the chance to align your own portfolio with the long term strategic moves of the world's smartest investors. For the first time, you can buy the exact same regulated, secure Bitcoin product, the ETF, as a multi-billion-dollar hedge fund. It levels the playing field in a way that's never been possible with other alternative assets like venture capital or private equity. The opportunity now is to understand this shift and position yourself accordingly. While the first wave of institutional money is here, we are far from mass adoption. Pension funds, sovereign wealth funds, and the majority of corporate treasuries are still doing their homework. The capital that has flowed in so far is just a drop in the ocean compared to what could be coming. The conversation has changed from "is Bitcoin legitimate?" to "how much of the global financial system will be built on this technology?" The arrival of big money validates the asset and provides a layer of stability and credibility it never had before. For the retail investor, this means the risk to reward balance has fundamentally improved. The potential for upside remains massive, while the institutional demand floor may help soften some of the downside risk. This is one of those rare moments in history where you can see a global economic shift happening in real time and actually take part in it. So, what's the real reason billionaires are buying Bitcoin in 2025? It's not hype. It's not a gamble on a price chart. It's because they are pragmatists. They're looking at the state of the world and making a calculated move to protect and grow their wealth. They're buying because the regulated gateway is finally open, with spot ETFs creating a safe and easy bridge for big money. They're buying because the economic indicators are flashing red, currency debasement makes an inflation hedge necessary, old portfolio strategies are failing, and regulation is finally de-risking the asset. And they are buying because they see Bitcoin as the foundation of a new digital economy. This flood of institutional capital isn't a temporary trend. It's the most significant permanent shift in Bitcoin's history. It represents a fundamental repricing of the asset as it moves from a niche speculation to a global institutional grade store of value. The distraction of daily noise is fading, and the real story is coming into focus. The smart money has made its choice. The only question left is, what will you do about it? If you want to keep digging into how this new financial landscape is evolving, make sure you watch my next video, a full breakdown of the newly approved Ethereum ETFs and what they mean for the future of crypto. Click the video on the screen right now. Don't get left behind. I'll see you over there.